Good afternoon, everyone, and welcome to Venable's annual Consumer Financial Services Outlook for 2024. My name is Andrew Biggert. I'm one of the co-chairs of our financial services group here at Venable, and I'm excited to moderate this fantastic presentation for you today. And I look forward to discussing the latest developments in financial services with my Venable colleagues. Before introducing today's panel, we need to start with just a few administrative points. This presentation is being recorded and will be available through Venable's website after the presentation. In addition, you may be able to earn CLE credits for today's presentation, and we will circulate a CLE code that you can use at the end of the presentation. In terms of today's agenda, we have about an hour and a half to cover the most recent and pressing developments in the financial services industry over both the course of the last year, but also looking forward to what to expect in 2024. We'll start with a review of the political landscape and how it may impact financial services. This is always one of the highlights of our annual presentation, but in an election year, it's even more important to understand how the election may impact the financial services industry. From there, we will discuss federal enforcement trends and the federal rulemaking process. We will then hit a number of hot topics, including developments in banking, privacy, payments, lending, and other topics of interest to the financial services industry. Finally, we'll end with a survey of state regulatory developments and how they may also impact the financial services industry. With so much to cover, it's no surprise that we have a full house of panelists today, and we've pulled together a number of our Venable colleagues with practices that focus on a wide range of topics, including enforcement, regulatory compliance, and legislative affairs. But to keep things moving, we'll introduce folks along the way as the presentation goes. So with that, let's jump right into what everyone is thinking about. How will the 2024 election impact politics and the financial services industry? What should we expect from Congress? What are the issues that policymakers are thinking about here in Washington and up on the Hill? And for this, I'll turn it over to my colleague, Chris Scribner.
Thanks, Andrew. Hi, everybody. Chris Scribner. I'm a senior policy advisor in the legislative group at Venable, and I represent financial services clients across the ecosystem in front of members of Congress and the administration. Today, depending where everybody is, you may know that Washington got some snow, and today is a snow day for the federal government. Its offices are closed, which is, I feel like, an appropriate metaphor for talking about what Congress particularly may do or has done in the last few years and may do in 2024, particularly in financial services, where it's been a struggle for Congress to pass legislation. Primarily has focused on oversight. Just as an example for thinking about 2023, the Senate passed two bills. Senate Banking Committee, passed two bills. The Recoup Act, where they had their first markup of legislation in this decade, and related to the mini crisis and about clawback of executive pay, and also passed a marijuana banking bill later in the year. The House Financial Services Committee passed legislation tied, one of their prime focuses on digital assets, on stable coins and market structure, but neither did the House take up the Senate legislation, nor did the Senate take up the House legislation, which kind of tells you even when one side of the Hill acts, it's very difficult or often absent the other side moving. And as we think about the election year and what may change, it is because it's a highly partisan political environment. There is divided government in terms of who controls which house, as well as narrow majorities in both the Senate and in the House of Representatives. So all of which, add to the difficulty in passing bills, finding true bipartisan ways to act. Typically, legislation, as I've suggested, is often messaging bills or bills that the other side of the Hill is unwilling to take up. So typically, we see a lot of legislative or hear about a lot of legislative activity tied to trying to get legislation onto must-pass bills, sometimes about government funding, sometimes about defense bills. We heard that a lot at the end of last year on a credit card routing bill, excuse me, the Durbin-Marshall bill, as it's also known for its co-sponsors, did not get attached to the defense authorization bill. But that's typically when we hear about legislation not to pass on its own. If you're following the kind of day-to-day in Washington, you would know that Friday is the deadline to fund the government to avoid a shutdown. And so as we think about another reason that it's going to be difficult to pass legislation, and we're looking at some of the priorities in Congress, one reason it's going to be difficult to pass legislation in 2024 is the fact that into this year, Congress is working to fund the government through the remainder of the fiscal year. So that we probably will see a bill to fund the government through March, but then there's going to be an intense negotiation by Friday to fund the government through March, but then an intense negotiation into the next month about a bill to fund the government through the end of the fiscal year. So again, we see how difficult it will be for Congress to focus, much less now we have a shorter year because of elections for all of the House, a third of the Senate, and obviously the president as well. So the list highlights some of the top issues of priorities for House and Senate Republicans and Democrats. Again, typical of lists we've seen in the past, but with a real challenge in terms of passing bills. A focus will be on oversight of agencies. We have the House Financial Services this week looking at the SEC's climate risk proposal as an oversight activity for this week. So a range of policies that will be discussed, but we don't expect significant action out of the committees or for the full Congress to take up any legislation. Shifting a little bit to the idea of politics and how politics may impact some of the long-term trends that I suggested that will do make it difficult to act. Today's the day after the Iowa caucus, obviously the formal kickoff of voting for the presidential election. One thing that we want to focus on or to think about in terms of big picture items is this year the chairman of the House Financial Services, Patrick McHenry, is not running for re-election. Blaine Luetkemeyer of Missouri, who's been very active among Republicans and was considered the leading candidate to replace McHenry, also has announced that he's not going to run for re-election. So we would expect, or we will have, a change in the leadership among House Republicans. We do expect French Hill of Arkansas to become the new leader of the Republicans in the House, but what's unclear, and this is also true in the Senate, is which party is going to win, which party will win. We probably expect the rare case where we would expect each house to flip, thus retaining divided government, but with slightly different fashion. So we would expect Ranking Member Hill, although it's possible there will be a narrow Republican majority again, and Chair Hill. In the Senate, Chairman of the Banking Committee, Sherrod Brown, faces a tough re-election fight. He has won in Ohio the last two times, even when the presidential, or particularly in the last case, when the presidential has trended the other direction in Ohio. So once again, we'll have to see if he can kind of buck that trend. Difficult race, but we do expect the Senate to flip. More confident in that prediction that the Senate will flip to Republican controlled, and wondering whether Tim Scott, who had an aborted run for the presidency, will take a more active role and really more aggressive role if he is chairman of the Banking Committee. And then TBD, who will be the ranking member. Brown, some of the other leading Democrats, including John Tester, also face tough re-election fights. More importantly, as we think about some of the big picture, is probably the presidential. Again, it will come down to about 6 to 8 battleground states to decide, and polling has been tight, and polling in those battleground states, once we get closer to the election, will be the key. I think what's important in the presidential, and that's probably the most, is obviously the impact it has on agency leadership. For instance, particularly the CFPB, whether or not, if Biden is not reelected, some of the Biden administration priorities, such as junk fees, as they term it, or fees on consumer products in particular, will that pressure will be abated. One thing to look for this year as we think about how Congress and the regulators interact is, especially when we consider a possible change in a party for the administration, is that Congress in the second half of the year will have the ability to invalidate bills, regulations passed by or approved by the regulators under something called the Congressional Review Act, which allows Congress, then the president, to sign into law, which would happen next year, those rules. And that is something that we really would be really keep a close eye on the elections, and particularly the presidential, because you typically need a change in party there. One of the broad impacts to close in terms of the idea that Congress is really slow to act is to push more authority into the regulatory agencies. We have seen, and there'll probably be discussion later, the fact that the courts have begun to check some of the power of the regulators and how much that might impact the scope of rules, even in the financial services sector, where there's challenge, obviously, and have been challenges to the CFPB's authority. But also we've seen banks being more willing to at least talk about challenging regulations in court, something we've seen that the banking trades have done or suggested they might do in anticipation of some capital rules that the Fed and other regulators would put out. So the overall trends of divided government, the kind of limited impact of Congress to pass laws, the focus on oversight, therefore pushing kind of more power to the agencies, with a kind of question about whether or not that authority might be limited by Congress. By the courts. Those are a few of the highlights that I wanted to note for this presentation. And Andrew, I'll kick it back to you.
Yeah, thank you so much, Chris, for that great discussion. I guess, at the end of the day, we'll just have to wait and see how all this plays out, at least on the political front. But I do think, one thing that we know for certain is that regardless of what happens on the political side or in the administration or on the Hill, is that the federal law enforcement agencies are going to remain focused on protecting consumers that use financial products and services. Enforcement never stops. And so I can think of nobody better to give us a federal enforcement outlook than my colleagues, Len Gordon and Liz Reinhardt.
Thanks, Andrew. I'll kick it off. Hope everyone's enjoying the snow day in Washington. I don't know if the Supreme Court sat today or not. They were supposed to. They're supposed to hear an important decision on how much deference agencies get. But in October, they heard a challenge to really the existence of the CFPB and the Consumer Financial Services Association case. It stemmed from a Fifth Circuit ruling that found that the CFPB's funding structure was unconstitutional, and it was in the context of a challenge to the payday lending rule, and that rule was voided. If the CFSA were to prevail, it would transform enforcement of consumer financial service laws and implementing regulations and really throw things into a tizzy. We'll see what happens. The argument was October 3rd. The challenge really is that the Bureau has a unique funding structure, and CFSA argued that that unique structure violated Article 1 of the Constitution, which vests Congress with the unique power to appropriate money. The CFPB receives its funding from the Federal Reserve. Federal Reserve is funded through bank assessments, and the Fifth Circuit found that two-step removed from congressional oversight funding structure meant that Congress had abdicated its power of the purse and had violated really the non-delegation doctrine and the doctrine of separation of powers, where the Congress really doesn't play any role in the CFPB's ongoing funding. At oral argument in October, as in many things, the court was divided into some pretty clear factions. Justices Thomas, Gorsuch, and Alito appeared pretty sympathetic to the Appropriations Clause violation argument. Didn't place much credence in the notion that Congress had placed a cap on the appropriation. They didn't think that was enough. Conversely, Justices Kagan, Sotomayor, and Jackson repeatedly challenged as to why the cap was not sufficient and why it had to be an exact appropriation from Congress. Justice Barrett questioned both sides on why some statutes with standing appropriations might be okay and others might not be. I think a lot of the answers there reflected the sort of the unique two-step structure for this CFPB. Justice Kavanaugh had questions for both sides on sort of these type of perpetual funding structures, and Chief Justice Roberts was focused on whether this was a increase in executive power. There was a lot of discussion and argument about remedies. A broad ruling here could gut all of the CFPB's enforcement regulatory powers, for entities that are supervised by it. It would throw supervision into suspension. With the FTC, there's a provision for an agreement between the CFPB and the CFTC to work out enforcement actions, but there's a lot that the CFPB does that the FTC doesn't do, and that the banking agencies historically had done, or things that no one else had done. So a broad ruling here could really upend the regulatory landscape for financial services. As you just heard, Congress is going to be closely divided the next session unless something dramatic happens between now and November. And what, if any, ability there will be for Congress to quickly fix the funding error if this court ultimately decides that the way the CFPB currently is funded is unconstitutional, is unclear. During oral argument, the CFPA had tossed out an idea that the Supreme Court could stay its ruling until Congress fixed things. That didn't go over well, and I don't see the Supreme Court doing that. So, we're going to talk now about the CFPB's enforcement activities, but sometime between now and June, we'll know whether that is going to continue. So I'll turn it over to Liz.
Thanks, Len. And yeah, I echo what Len said about, what is the remedy here for the Supreme Court, depending on how the court comes out, is going to be, I think, almost as important as the substantive ruling, because as we're seeing this year, we had geared up for what was supposed to be a pretty active CFPB enforcement year, and that really hasn't been the case. We did see some signs pointing to increased emphasis on enforcement. There was a big hiring announcement that they were going to hire more attorneys to focus on enforcement, but by the numbers, that really just hasn't panned out. The CFPB reported 22 total actions. That's combined administrative and civil. That's in keeping with what they've been doing in most recent years. We saw about double that in what we would consider busy years like 2015 and 2020. But more recently, we're seeing about 18, 19, 20 total actions a year. And while the CFPB hasn't published its report on the amount of redress and penalties that have come about from the 2023 enforcement actions, my lawyer math has it at about 22 million in known redress and 240 million in penalties. Again, very similar to the past 8 years. The notable exception would be 2022, where the total amount was 2 billion, but that was the result of one notable case. That was very much the outlier. And so the question is, why aren't we seeing any increase in enforcement? And it could be because the agency is waiting to see how the Supreme Court case pans out, or it could be that there are larger initiatives that the agency is preparing for in the upcoming year. So looking at civil enforcement actions, we saw 15 new civil enforcement actions. Of those, 3 were stipulated orders, meaning that they were new actions filed in federal court, but they were filed with stipulated resolutions. And so they're not really active pending litigations. So that leaves 12 pending litigations, and about half of those were actions to enforce CIDs, which are still notable and worth tracking because they give a window into where future enforcement actions may be going. of the 12 pending actions, most of them are either stayed or they have motions to stay that are pending, including those that are fully briefed, based on the idea that no action should take place until the Supreme Court has ruled on the constitutionality of the agency's funding. And of course, whether you believe that will happen or not, in whatever direction you think that case will go, we want to make sure to preserve those arguments. So it's not surprising to us that people are continuing to raise them. So in terms of what types of civil enforcement actions we saw, consistent with what we had discussed last year, we saw the CFPB had a focus on discrimination in the provision of financial products, in particular, groups that the CFPB has identified as vulnerable to illegal practices. Notably, in December of 2023, the CFPB brought a lawsuit along with the DOJ alleging misleading and discriminatory practices by a mortgage loan provider. This action is in keeping with the DOJ's Combating Redlining Initiative, which was announced back in 2021 and is a multi-agency effort to combat discriminatory practices in home lending, among other things. And so this particular action is alleging discrimination in the targeting of specific groups for loan products, as well as exploiting language barriers in how disclosures were provided. So that case was just filed in December. I believe the last time I checked, there hasn't even been, an answer or a motion. So we will be looking at it to see what happens this year. The other issues of we're seeing a continued focus on auto loans as well as small value loans, which is in keeping with past practices and enforcement trends. And again, many of these cases are stayed or have motions to stay pending the Supreme Court's decision. So moving on to administrative enforcement efforts, we saw 19 total enforcement actions in 2023, all of which were stipulated orders. So we aren't seeing any sort of adjudication in terms of like the agency running proceedings and then making decisions when it's bringing administrative enforcement. It is all about stipulated orders. There is a little bit more variety in the types of claims and topics with the administrative enforcement, but still a healthy amount of attention being paid to home and auto loans. We also saw some orders entered related to overdraft and insufficient fund fees, which we've seen has continued to draw the attention of regulators, not just the CFPB, but throughout the country. And so with that, I'm going to turn it back to Len, who's going to talk a little bit about FTC work.
Thanks, Liz. The FTC continues to be busy on consumer financial issues, but perhaps not as busy as in other areas. As anyone who's been watching knows, the FTC currently has an incredibly broad agenda, both in law enforcement, policy issues, and rulemaking. And sort of meat potato financial fraud actions probably aren't consuming as much of the agency's resources as they have in the past. They're not as busy, say, on debt collection, things like that. They are a little bit involved in cryptocurrency, but mostly not the nuts and bolts of cryptocurrency, but sort of deceptive marketing about things related to cryptocurrency. We'll talk about some of their other rules and initiatives in a second. They are continuing to go after debt relief, debt consolidation type cases. And one of the things that we're seeing a lot of in our practice is the FTC is very much going after payment processors again, Operation Choke Point type activity. And they're getting very imaginative and aggressive there. They're using laws like ROSCA, the Restore Online Shoppers Confidence Act, that deals with continuity, negative option marketing, and having that apply to a payment processor's relationship with its merchants, people who are opening merchant accounts. We're seeing them try and seek civil penalties in payment processing cases. We're seeing them refer certain matters to the DOJ for criminal involvement, touching on payment processing activities. If there's telemarketing involved at all, they're using that as a shoehorn to get both remedies under Section 19 of the FTC Act and civil penalties. And, especially in a payment processing context, civil penalties can be quite draconian. They're $50,000 plus a violation. And when you're talking about a processor who may make pennies per transaction, that asymmetry is chilling and a challenge if you're trying to resolve things with the agency. The FTC continues to be involved in student debt issues and focus there, as well as auto finance and anything dealing with car sales, especially used car sales or car sales that are focused on folks on the lower end of the economic spectrum. Can I get the next slide, please? So I wanted to talk a little bit about another Supreme Court case. This is sort of the con law portion of the program. It's the SEC versus Jarchese case, and it affects both the FTC and the CFPB, probably even the CFPB a bit more. Liz? Or is this one mine? You tell me. I can't remember.
I think this one's yours, but I do
Okay,
agree
I got
that
it.
it affects the CFPB as much as
It's been a
anything
crazy
else.
day,
Yes.
so I apologize to everybody, and especially to Liz. So I saw the blank look on her face there. So the SEC, like the CFPB and the FTC, uses administrative law judges to adjudicate certain things. The CFPB hasn't been terribly active doing that lately, except for settlements. But in actual enforcement actions, I don't think they've brought a litigation in an ALJ proceeding in several years. They amended the rules to make them even more friendly to complaint counsel, but they're not using it, perhaps because of some of these reasons. So the Fifth Circuit, you'll see a trend here. The Fifth Circuit is where the attack on the administrative state by the Federalist Society is probably most active. It's very skeptical of government action in the Fifth Circuit, and defendants do everything they can to get in the Fifth Circuit for that reason. But in an SEC administrative trial, the Fifth Circuit found that the imposition of monetary penalties in an administrative action deprived the defendant there of his Seventh Amendment right to a jury trial. And there's some appeal there. There are lots of things where people get fined without a jury trial, but I think the size of the fine there is probably partially what triggered it. The non-delegation doctrine is a favorite of those trying to narrow the scope of the administrative state. And here the challenge was that by delegating to the SEC sort of unfettered discretion to choose whether it goes in federal court or through an administrative proceeding, that unintelligible principle was a violation of the non-delegation doctrine. And then the final challenge was to the way ALJs are appointed. They're appointed by the commissioners who were appointed by the president, making them 2 steps removed from presidential appointment and allegedly violating Article 2, that the president must take care that the laws be faithfully executed through his appointments. Oral argument was heard on that one at the end of November. We'll have to wait and see, but I don't think they're going to throw up a whole administrative law structure, but one never knows. All right.
So I agree, Len, in the sense that it doesn't seem like a lot of courts have jumped on the Fifth Circuit's bandwagon in Jarchese. I'm not sure why. It seemed like that they had really tied everything up without any loose ends, but a number of litigants have tried to bring similar arguments and claims or defenses, and they have all been unsuccessful when considered by a court. And I caveat that because we really can't say whether the threat of a Jarchese-like argument has changed the way an agency has formulated an action, or maybe changed the way an agency has brought an action. We did see at least one case where an administrative proceeding may have been dropped, around this time. Again, it could have just been a coincidence, but typically, unfortunately, for those who are bringing them, courts are not eager to jump into that same Fifth Circuit battle against the administrative state. That is not to say that litigants shouldn't bring these types of arguments. There is a real risk to the agency's ability and authority here, and the worst case scenario would be to waive those arguments because they weren't brought up in the lower court. So we would still recommend that these arguments be made. It's just you have to kind of steel yourself for a loss, at least in the district court.
one of the interesting things that did happen last term with the Supreme Court is that in the Axon case, the Supreme Court did rule that if you're subject to one of these administrative proceedings, you don't have to wait to the end of it to challenge the constitutionality. You can file a declaratory judgment action in federal district court, sort of collaterally attacking the constitutionality of the proceeding. The Supreme Court didn't go to the merits of the constitutional challenge, and so far, no one, I don't think, has really taken up the banner that any of the constitutional arguments that we flagged here, whether it's the Seventh Amendment doesn't apply for the FTC because they can't impose monetary penalties in their administrative proceedings, unlike the CFPB. But the non-delegation, Article 2 removal, due process, that's a challenge just really at the way the FTC is structured as prosecutor, appellate advocate is just sort of unconstitutional. That would require overturning some old Supreme Court precedent on this issue, and so far no one's been able to do it. And then equal protection argument really is an antitrust issue, but it will bleed over to the FTC a little bit. Some mergers get challenged by justice, and they have to go right to the federal district court. Some mergers get challenged by the FTC, which can do it in its own in-house proceeding. And there are arguments that disparate treatment is unfair, but that is how Congress set it up in its infinite wisdom. And so far, no one's been able to find that wisdom constitutes a constitutional violation. So I think with that, we're going to turn it back to you, Andrew. Thank you.
Yeah. Thanks, Len and Liz. That was great. I mean, obviously, enforcement risk is going to remain as it always does, but there's certainly some developments that need to be monitored, especially when it comes to the CFPB's authority and some of these other regulatory authorities that you mentioned. But of course, enforcement is just one aspect of the regulatory picture, and it's what normally happens on the back end after there's been some violation of a law or a rule. And so, from a compliance perspective, understanding what those rules are is kind of the first step, and obviously very critical. So in the next couple of slides here, we're going to talk about some of the new rules that the agencies put into place in 2023, just kind of a quick look back, but then also what are the proposed rules that federal regulators have in store moving forward. And so our colleague Connor Webb will spend the next few minutes kind of walking us through these different issues. Connor?
Thank you, Andrew. Hi, everyone. My name is Connor, and I'm an associate in the Financial Services Group. So to jump right into things, we see that the CFPB, according to their fall regulatory agenda released at the end of Q3 last year, they have been active in both proposing new rules to make and actually finalizing some rules in the form of either changes to the CFR or existing rules, or in the form of advisory opinions or clarifying existing obligations or their view of them. Moving on, we can see the final rules that the CFPB has implemented this year touch on a variety of different topics. Andrew, can you go to the next slide? We see them touching on digital mortgage comparison shopping platforms, invoking RESPA and Regulation X to release an advisory opinion about how referrals and compensation agreements can work there. We see small business lending data collection and new reporting obligations for lenders to small businesses. We are also seeing rulemaking in time-barred debt, Fair Debt Collection Practices Act, fair credit reporting with new reporting and background screening requirements or clarification of existing, as well as the LIBOR transition, a rule addressing the fact that LIBOR tenors are being phased out of the US and we're moving on to different standards. Looking ahead, though, there are several rules that we wanted to highlight. The first is in keeping with the CFPB's focus on junk fees and other fees that consumers might be required to pay. The CFPB has a proposed rule out there to amend Regulation Z to address credit card payment late fees. They plan to lower the safe harbor dollar amount, remove inflation adjustments for that safe harbor dollar amount, and place a 25% cap on the required fee or the amount of any fee that any consumer can be required to pay in connection with the late payment, so 25% of the late amount. The comments closed on that one in May, and we have not heard anything on that since. But moving on to the rulemaking on personal and financial data rights. This relates to the so-called open banking provision of the Dodd-Frank Act, passed almost over a decade ago. Section 1033 asked the CFPB to implement a system for open banking similar to what you might see in the UK or the EU, where the consumer is able to take some ownership or control over their financial data, directing financial institutions to send it to certain people and allowing it to be used for various purposes covered by the rule. And this one has been ongoing for quite some time, having to jump through a number of hurdles with the Small Business Regulatory Enforcement Fairness Act, and panels of small businesses weighing in pursuant to that. This rulemaking released by the CFPB follows a report released earlier this year by the Small Business Regulatory Enforcement Fairness Panel, discussing the pros and cons of the CFPB's proposal in more detail. And finally, we have one more proposed rule to discuss regarding the CFPB's supervisory authority, and its plans to extend that to general use digital consumer payment applications. For this one, I'm going to turn things back to Andrew Biggert to discuss some of the details here. Andrew?
Yep. Thanks, Connor. I think this might be one of the most recent notices of proposed rulemaking that the CFPB released. Very quickly, the CFPB, they're not just an enforcement agency, they're also a supervisory agency, right? They have the ability to conduct examinations, just like a traditional bank regulator might. And they can do that by issuing rules defining different types of larger participants and specific consumer financial services markets. So they issued a proposed rule to define a market for larger participants that provide general use digital consumer payment applications. These broadly can be viewed as kind of digital wallets and kind of related types of services that help do general fund transfer type things and facilitate payments and transactions. The proposed rule came out with a test for how they would define larger participants that would be subject to supervision and the supervisory process. It would be essentially any kind of non-bank entity that is providing digital consumer payments with an annual volume of at least 5 million transactions and is not a small business under the SBA rules that they have in place. This was, I do believe the comment period may have closed on that, but it's definitely something to track moving forward.
Thank you, Andrew. And turning now to the FTC, we see a lot of activity, but most of it kept in the proposed and pre-rule stage, with only a couple of rules coming out according to their September 30th regulatory agenda, though we do know a few more have come out since then, such as the automotive rule. But there are a few of these proposed rules that are worth highlighting, and we're going to talk about those right now, and I'll turn things over to my colleague Len Gordon to discuss some of them.
Thanks, Connor. The FTC is engaging in more rulemaking now than it probably has in the last 30, maybe 40 years. A lot of that is driven by the FTC's loss of its ability to obtain equitable monetary relief for violations of Section 5. So to fix that hole in its remedial tool basket, the FTC is engaged on a bunch of rulemaking. If they can prove someone has violated an FTC rule, they can seek civil penalties or monetary redress under Section 19. So that's what's driving a lot of this. A couple of these, and very timely, the negative option rule. I believe there was certainly scheduled to be a session today, a hearing on the rule. I don't know if it got adjourned or not. I'm pretty sure it actually happened because I heard people were watching it, so it must have happened remotely. This is, the FTC has been very active for years in going after negative option or auto renewal type marketing practices, as have a number of the states. This would make it a rule. And the Restore Online Shoppers Confidence Act ROSCA only applies to online sales. This would apply to all sales. It has enhanced requirements for disclosure and what must be disclosed and how you obtain consumer consent, cancellation and save attempts. A lot of people, including the FTC, refer to this as the click to cancel rule. It'll make it much easier to cancel, make it harder for merchants to try and save the sale. Has requirements regarding the reminders, confirmations, and other notices that merchants must provide to consumers. Comments on this rule closed last summer. As I mentioned, there was a hearing today. I would expect that a rule will come out soon. You can expect that the business community is likely to challenge that. Connor mentioned the CARS rule. There's been a challenge filed to that by auto dealers, and I think almost any rule that the FTC promulgates right now is probably likely to get challenged. Can we go to the next slide? So this is sometimes referred to as the junk fee rule. A lot of it is focused on drip pricing, where you are quoted a price in advertising of one rate, and then as you check out or go to pay, you find out that there are other fees that were not disclosed or were poorly disclosed. The rule is meant to make those illegal. You have to advertise the true price, including all mandatory fees. If there are optional fees, those don't have to be included in the price, but it's really meant to get at bait and switch pricing. It also prohibits misrepresentations regarding the nature and purpose of fees. If you're saying something is to cover shipping and handling, and it's grossly disproportionate to your shipping and handling, you may have issues. And if there are requirements regarding fees, you may have to disclose those as well. The comment period here closes in February. There probably, though not definitely, will be I think there will be a hearing of some sorts, and that has not yet been scheduled. So let's go to the next one. The FCC has been very busy on consumer reviews and testimonials, especially in social media, but really in all areas. The FTC put out guidance on consumer reviews and testimonials, and at the same time, actually the next day, issued this rule on, I guess, what you would think of as the really egregious violations of or misuse of reviews and testimonials. So creating fake reviews, purchasing fake reviews, offering incentives for positive reviews, and repurposing real consumer reviews. Consumer reviews product A, and I use it to have them rave about product B with they've never used. All those things are prohibited by the rule. You can't use these reviews in your marketing materials, as well as not just having them on social media. If you're representing reviews are independent and they're not, that's a violation of the rule. You can't suppress negative reviews unless you're doing so because they're obscene or something like that. And you can't sell likes in social media context. So comments here closed in September. I suspect the rule will come out later this year, and I also suspect that it will be challenged. I think that's it for me.
Great,
Yep.
thank you, Len.
All right, thank you.
We have one order that came out of the FCC, which is not an agency we would typically associate with consumer financial protection, but they do have some authority under the Telephone Consumer Protection Act and the FCC Act to help regulate how marketers interact with consumers and contact consumers. And this order is a significant one because it is aimed at lead generator websites who collect phone numbers and then pass those on to third parties for future marketing messages and communications. Essentially, what the FCC has done with this order is apply a lot of the TCPA and do not call protections to text messages instead of just to calls. And so now there are, while that has implications for the telecommunication providers themselves, it also, another part of the order has implications for lead generators as well, because they have clarified the requirements around gathering consumer consent to future marketing communications that must be gathered by these online shopping comparison platforms before they're able to refer a consumer to another service provider, seller, or other companies like that. It really has some, or it's very, very different from the way things have been. Turning to the next rule, there's one final rule that's coming out of the Financial Crimes Enforcement Network that I'm going to let my colleague Andrew Biggert talk about. Andrew?
Yep. Thanks, Connor. So we'll just end kind of the rulemaking by looking at recent FinCEN series of rulemakings that they've been doing in response to the Corporate Transparency Act. And essentially, the Corporate Transparency Act required FinCEN to set up a system where businesses need to provide their information to FinCEN so that they can collect beneficial ownership information, right? Which is not something that there's been a national database for in the past. It's been very much kind of a state-by-state type issue. So FinCEN has been coming out with rules. Most recent one is about what companies have to provide their information, et cetera. FinCEN has already come out with a rule talking about which types of entities can have access to this information, the beneficial ownership and corporate information, and obviously it's federal agencies and law enforcement can have access to it, but it's also financial institutions. And financial institutions, if we're talking about banks and broker dealers and others, they have an obligation to perform customer due diligence and to gather beneficial ownership information. So there will now be a database that is coming online that they will be able to have access to. The one rule that still kind of remains to be done by FinCEN is to kind of reassess or address how regulated financial institutions, how their customer due diligence obligations and their beneficial ownership information collection obligations will be impacted by this new beneficial ownership registry. So that's one other area to keep an eye out for over the course of the coming year. All right, so clearly, there's a lot going on from the rulemaking perspective, and we covered most of it. We'll probably cover a little bit more as we continue to go through the presentation, but we really want to shift now to looking at some specific industries and some specific areas. And we're going to start with banking, which has seen a flurry of regulatory activity since some of the high-profile banking collapses last year. And it's activity that doesn't seem to be slowing down at all. So I'm going to turn it over to our colleague, Max Benici, who can give us the rundown on what's happening in the world of banking.
Thanks, Andrew. I'm Max Benici. I'm counsel here at Venable. We'll dive in now to bank reg. Right now, we're in a regulatory super cycle, like Andrew said, following the 2023 spring bank failures. That means there's more regulation, there's more supervision, there's more enforcement activity among the federal banking agencies. And they're basically looking at safety and soundness, a back to balance sheet basics approach, fundamental risk management, and generally that means less tailoring. So even if banks have hundreds of billions of total assets in, kind of differential, a lot of these rules are going to apply, and a lot of these approaches are going to apply uniformly to more banks. There also seems to be less time. By that I mean the regulators seem like they're in a hurry to get these rules out, to get comments in, to wrap things up, probably, like our colleagues said, because of a lot of the political considerations this year. Even on the non-bank side, these rules are going to have a ripple effect, whether that's the capital rules, which we'll dive into, whether that's third-party risk management that the banks are supposed to do over their non-bank vendors. Non-banks are really not immune from what's going on. So let's take a look at the timeline, and we can proceed, Andrew. Thanks. And basically, there's been a steady drumbeat of rulemakings and developments. Thousands of pages have come out, and if we want to look at this kind of in terms of the subject matter, there's basically, we can proceed. There's basically a lot on the prudential side, a little bit, but notable on the social policy and consumer protection side. Like Andrew said, there's some notable financial crimes developments at FinCEN. We can't cover everything, but we can give you the highlights as to kind of what's been going on. So let's dive in on the prudential side. Notably, there's a proposed rule for the Basel III endgame. That's the proposed capital rule. Comments are due today. There's still some hours left to get yours in. But basically, this would really change the capital rules, make things a lot harder in terms of lending and certain operations and other bank products. It's very controversial, and not only have there been substantive issues raised, there's been procedural issues raised. So we're seeing the big trades kind of show their litigation strategy, preview their litigation strategy a bit. So it'll to be seen what happens. But it's a very important rulemaking. There's also a companion rulemaking for resolution planning. So in addition to lots more capital and differently weighted capital, risk-weighted assets for that capital, banks were going to have to basically issue plain vanilla long-term debt to serve as a further buffer. So the cost of banking under these proposals would go up. The flip side, of course, is that they would hopefully be more resilient should any more banks fail. We can't get into everything, but on the non-bank side, we note that the FSOC, which kind of brings together a lot of the agencies, issued a new designation framework even for non-banks. So if a non-bank financial company is designated, it would be subject to the kinds of Federal Reserve supervision and prudential standards that apply to banks and bank holding companies. Those designations haven't happened yet. There are a lot of ways that could go down. It would be a significant development, but the framework has been updated, which means as the regulators focus on banks as a regulated entity, and more activities might be pushed out of that regulated sector into a non-bank or less regulated sector, this would provide perhaps a backup authority to mitigate against financial stability risks and things like that. The federal banking agencies also harmonized their expectations for vendors of banks and how banks should manage those relationships. We'll see how that plays out in the enforcement context in a few minutes, but largely speaking, banks are expected to manage the entire life cycle of their relationships with vendors, and that remains a huge priority. There's more on our client alerts and in these slides for you to look at. We'll move along to social policies real quick and note that there's a final CRA rule, the Community Reinvestment Act rule, which again, new framework. Banks are going to have to rethink their CRA plans, their lending approaches, how to comply, how to get favorable ratings. These ratings are incredibly important because they affect what banks and bank holding companies can do in terms of expanded powers and the way they can do it, whether, for instance, prior approvals needed. It's interesting because the CRA rule arguably requires more lending, whereas the proposed capital rule would make that lending more costly. The interplay is not exactly clear, and we think that that's going to bear out in a lot of the comments. On the consumer protection front, we just note that kind of at the end of last year, the FDIC's final rule on advertising kind of snuck in. And in addition to modernizing the rules around the official FDIC sign at physical locations, they also introduced a new official digital sign that is needed on bank websites, mobile apps, things like that. It clarifies FDIC rules on misrepresentation of deposit insurance. And banks have to have policies and procedures for these regulations. And it comes on the heels of a big effort, the FDIC, to police the arena through cease and desist letters. Especially for non-bank partners and bank partnerships, this is a big issue that the FDIC is going to remain focused on. In terms of bank supervision, like we previewed, there's more. They've ramped up supervision. Next slide, please. We can basically expect exams to be longer and harder. Ratings, there might be downward pressure on ratings, especially the use of the management rating to hold boards and management accountable. And although bank supervision is inherently confidential and secretive, there was actually a major leak in August in the press about supervision, especially among the regional banks, which confirms this trend. Next, turning to enforcement. There's been about 35 enforcement actions since the spring 2023 bank failures, pretty evenly split between civil money penalties, written agreements, and cease and desist orders, with the OCC and the Fed kind of leading the charge. It's about 4 per month, with July being the most active month. In terms of kind of what areas that we're going to be looking at in these enforcement actions, UDAP, fair lending, BSA, AML issues, these of course remain important enforcement priorities, and civil money penalties are likely to be assessed in these issues. But we're also seeing kitchen sink enforcement actions. These are the kind of 20 to 30 page enforcement actions that basically tell a bank how to run itself, and at a very granular level. Civil money penalties don't solve these problems, so these are in the form of written agreements or cease and desist orders, but they're very important. They're on the rise. They go from everything from board and management responsibilities to capital and liquidity and concentration risk, all the things that were at issue in the spring bank failures. These are now kind of making their way into enforcement actions. And then I'll just end with a note again on third-party risk management. That's accounting for about a quarter of the recent enforcement actions. It's specifically called out, and the regulators are, direct kind of reiterating their guidance in the form of enforcement actions. These can be avoided, right? And we also note that not only the enforcement actions are looking at non-bank vendors, at a contractual level, but even non-bank affiliates within a holding company. Banks really need to be aware of how their actions with non-banks, whether inside or outside of the holding company structure, might present risk. The agencies are on top of this. They're bread and butter issues, and the focus, is not going away anytime soon. Thanks.
Great. Thank you, Max. It's definitely going to continue, I think, to be a busy year on the banking front. But another area that's also going to be busy, as it has been and likely will continue to be, is privacy. And so our colleague, Catherine Marshall-Timmons, will walk us through some of the privacy laws that are coming to a state near you in 2024.
Thanks, Andrew. I'm Katie Timmons, and I'm an associate in the Privacy and Data Security Group, where I advise companies in various industries, including financial services, on state and federal privacy laws. Today, we'll spend just a few minutes discussing new state privacy laws. You may increasingly be hearing about the many state privacy laws that have been enacted over the past few years. And as I'll touch on, many in the financial services industry may be able to take advantage of exemptions under these laws, but it's important to stay apprised of updates and to assess whether exemptions are applicable, and if not, take steps to apply. So as shown on this map, more than a dozen states now have comprehensive privacy laws. While a few states have narrower laws, such as Louisiana, which has a law focused on minors, New York, which has a health-focused geofencing law, and Washington, which has a law regulating consumer health data, the majority of state privacy laws share a few common features. Specifically, the laws grant rights to consumers related to personal data. For instance, such laws grant consumers the right to access personal data about them, the right to request that personal data be deleted, and the right to opt out of certain practices, such as sales of personal data or processing of personal data for targeted advertising. If you've attended this presentation in previous years, you may have noticed how rapidly the map shown on the last slide has changed. The first state to pass one of the comprehensive privacy laws was California, and the California Consumer Privacy Act, or CCPA, went into effect in 2020. 4 more state laws went into effect last year, and others will go into effect between now and 2026. Additionally, with most state legislatures now in session, we expect more states to pass similar laws this year, particularly as preemptive, comprehensive legislation at the federal level remains quite challenging to pass. Fortunately for the financial services sector, the state comprehensive privacy laws all have exemptions relevant for financial institutions. Currently, all states other than California, which is the real outlier here, exempt financial institutions subject to the GLBA from the comprehensive privacy laws. However, the California law, the CCPA, exempts only data subject to GLBA. This means that financial institutions subject to GLBA may have obligations under California law for data that is not subject to GLBA. This might include, for instance, personal data collected on a marketing website. Similarly, the CCPA exempts data subject to the FCRA, but it does not specifically exempt consumer reporting agencies. Additionally, and in the real big takeaway for the CCPA, is that it applies to personal data collected about personnel and business contacts. So even if a financial institution does not collect any personal data about consumers that's subject to the law, it may well be subject to this law for its personnel and business contact data. The CCPA is unique in this regard, as the other state comprehensive laws to date do not apply to personnel or business contact data. And with respect to enforcement, the CCPA is not enforced by private plaintiffs. However, both the California Attorney General and the California Privacy Protection Agency, which is an agency established to implement and enforce the CCPA, both actively enforce the law. In fact, there's been at least one public enforcement action targeting a fintech company. Here, a business offering financial services to minors failed to provide a compliant privacy notice and failed to include an appropriate opt-out mechanism. Not only does this case demonstrate that California regulators are keeping an eye on the financial services industry, it also demonstrates the value of investing in outward signs of compliance. In particular, having a compliant privacy notice can help to demonstrate a company's compliance with the CCPA overall. And in general, financial services companies doing business in California should evaluate if they're subject to the law, and if so, take steps to comply. This includes paying close attention to regulations issued under the law. While many regulations have been finalized, the California Privacy Protection Agency is actively developing new regulations related to automated decision-making and cybersecurity audits. Although some regulations remain in development, there is no time like the present to take steps to drive compliance with existing regulations if you haven't yet. The CCPA has been in effect for some time, but it had a cure period for alleged violations until last year. The cure period has since been sunsetted, but enforcement of certain regulations has been stayed until March 29th of this year. And as recently as Friday, the California Privacy Protection Agency expressed its interest in vigorously enforcing the law and its regulations. So entities subject to the law that have not taken steps to comply with it or its regulations would likely benefit from doing so before the regulations can be enforced starting in March. We also suggest that companies remain aware of changes to state privacy laws as new laws are being enacted rapidly. And we have also seen existing laws be amended with increasing regularity. So some of these exemptions I discussed could well be removed as states continue to consider these issues. And back to you, Andrew.
Great. Thank you very much, Katie. So now I'm going to turn it over to my colleague, Chris Boone, to discuss one of my favorite topics and where I spend a lot of my practice as well, which is payments and some of the related issues. I work closely with Chris on these, and so I'm excited to hear about the latest developments in these areas.
Thanks, Andrew. I am Christopher Boone. I work in the financial services group, specializing in payments and cryptocurrency regulatory issues. And we're going to walk through some of the regulatory updates in this space and what to look out for in 2024. So the first topic is the Credit Card Competition Act. It was reintroduced by Senator Durbin in June, and it continues to build support while facing opposition and challenges. Essentially, the act aims to enhance credit card competition by requiring card issuing banks with over 100 billion in assets to enable two credit card networks, at least one of them being not Visa or MasterCard, on a single card. And so the idea would be that would then allow for greater competition and potentially reduce the amount of fees that merchants have to pay. Another important regulatory development, the Federal Reserve Board has proposed to lower the interchange fee cap for debit cards in its Regulation 2. In addition, the proposal would update that interchange fee cap every other year going forward based on survey data collected from the large debit card issuers.
Chris, do you want me to jump in quickly on the enforcement
Sure.
updates? Yeah. And I think Len already touched a lot on some of this. I mean, we are continuing to see the FTC in particular and some others look at payment processors and really be focused on those types of issues. I think one of the most recent ones was the FTC versus Nextway case, which was last year. But while there haven't maybe been as many public matters, there certainly are a number of ongoing investigations. And as often is the case with the FTC, as they review kind of the payments industry, they continue to kind of monitor, developments. And one of the issues addressed in the Nextway case was the merchant of record model, which is a model that is sometimes used to process different types of transactions. And so that is one area that has gotten attention and may continue to get some attention moving forward. Chris, you want to
Sure.
talk to us about potential fraud related issues in the payment space?
So peer-to-peer payment fraud is one of the big focuses for 2024 by regulators. Currently, Regulation E requires banks to refund or credit customers for unauthorized transfers made by third parties. But regulators are now considering widening the scope of Regulation E by requiring banks to cover authorized transactions that result in fraud losses. Essentially, fraudulently induced transactions approved by consumers would be considered as unauthorized transactions under Regulation E. This effort for how to interpret Regulation E has some support from the Senate. A group of senators sent a letter last year to the banking regulators, urging them to review the customer reimbursement practices of banks that are using peer-to-peer payment services. And this is a very contentious issue between the different parties that have stake in this game, between the banks wanting and needing to limit liability and consumer protection concerns on the other hand. Another really big focus for 2024 is real-time payments. The Federal Reserve's FedNow service was just launched over the summer last year, and participation in that service has been growing rapidly and continues to show strong growth and diversity heading into 2024 with over 331 financial institutions now sending or receiving on that network. The Clearinghouse's RTP network, which was introduced in 2017, also continues to show strong growth with over 29 billion in transactions in Q2 of 2023, which is up from 18 billion in transactions in Q2 of 2022. Similarly, Visa's and MasterCard's push-to-card program, so this is Visa Direct and MasterCard Send, continue to grow at a fast pace with more and more companies and fintechs looking to utilize those functionalities. The program essentially allows businesses or consumers to push funds to a cardholder's credit, debit, or prepaid card account. And then finally, for payment areas of focus, FBO accounts are continuing to kind of come into focus and be utilized and potentially maybe scrutinized in 2024. So for those who do not know, an FBO account is a type of custodial account that is designed to minimize the risk of a fintech or a payments company engaging in regulated money transmission activity. The way this works is that the funds are held in the bank account for the benefit of the fintech's clients, indicating that the funds in the account are owed to those parties and not the fintech. The fintech accordingly does not receive funds for transmission, but rather issues payment instructions to the bank. But that FBO account structure is very tricky and requires careful implementation. So some of the issues to consider include, can the bank effectively monitor transactions and mitigate financial fraud? Does the relationship between the bank and the fintech address anti-money laundering and sanction screening requirements? Does the fintech have consistent ledgering system to ensure the proper management and distribution of the funds? Because even small errors can result in big problems and headaches down the line. And notably, reflecting the complexity of the FBO account structure, a fintech-focused bank recently announced it was going to limit the availability of FBO accounts for its fintech partners. There have been a number of very important updates in the cryptocurrency space. Very recently, just last week, the SEC approved the first spot Bitcoin ETFs. These are exchange-traded funds. And also in the CFPB's proposed Consumer Digital Payment Applications rulemaking, which was discussed a little bit earlier, which would subject large companies that provide payment apps and similar applications to CFPB supervision, stated that the CFPB's position is that the term funds includes virtual currency. As a result, the transfer of virtual currency by or on behalf of a consumer would qualify as a consumer payment transaction under the CFPB's proposed rule, but would also seem to subject virtual currency platform operators to the Electronic Funds Transfer Act, the FTA, in Regulation E. So that is something to very closely watch, that we are curious about and seeing how that kind of unfolds down the line. Also, in October, California enacted the Digital Financial Assets Law. This is similar to New York's BIT license type of licensing structure. It requires individuals or entities to obtain a license to engage in digital asset business activities, such as exchanging and storing cryptocurrency. It also empowers the DFPI to examine and initiate enforcement actions against licensees, similar to other financial service providers and institutions. This law the requirements for licensing for this California law don't take effect until July 1st, 2025. Another area that we're closely looking at is the SEC's case against Ripple. It is set to go to trial in April. So last year, the court issued its highly anticipated decision whether Ripple sold its XRP token as a security. The court then held that XRP as a digital token was not necessarily a contract or scheme within the Howey requirements for an investment contract. Thus, part of its sales were not a securities transactions, but another part of its sales might have been or were a securities transactions. And so now, coming up in April, the trial will continue, and the outcome of that case will be fairly important for the industry, in general. And finally, last year, the SEC brought enforcement actions against Coinbase and Binance. These are two of the largest cryptocurrency exchanges, alleging that they engage in unlawful sale and unlawful unregistered offer and sale of crypto assets. So that indeed the SEC is continuing to aggressively scrutinize players in the cryptocurrency industry.
Thanks, Chris. Also wanted to touch briefly on artificial intelligence and developments in that area. It's certainly a place where a lot of financial institutions are investigating and trying to understand not only how can they use artificial intelligence for their own internal purposes, but are there fraudsters that are using kind of technologies, and how do they mitigate those types of risks? And the flip side of that is that the regulators are also really starting to hone in and start to investigate artificial intelligence. It's still early. I mean, artificial intelligence technologies had existed, obviously, for a number of years, but over the course of the last year with ChatGPT and other similar technologies, there's just been a really big increase in interest. And so the regulators have issued some guidance. They're continuing to kind of explore the technologies and try to understand it. On the financial services side, it does hold the promise of being able to be used in a number of different ways. AML and fraud monitoring. It can be used for identity verification of customers. It can be used for underwriting and similar activities when it comes to lending. Even things like customer service and internal analytics. It really has a number of different uses, and a lot of different financial institutions, according to statistics, are really investigating the use. And why there's a number of different benefits, potential cost savings, efficiencies, and the like. It also has to be kind of done carefully, because like any new technology, there can be results that aren't anticipated. It may not work the way it's expected. And so it is an area that can present some risk as well as these technologies are adopted. And so any financial institution looking to expand their use of AI-based technology, I think at a minimum, there's a couple of things to keep in mind from the compliance perspective. One is really make sure that you understand the technology and how it works, so that it's something that you can explain to your regulators, and that it's not just a black box, but you actually understand the inputs, the outputs, and how it works. Develop a plan for how it's going to be used, and make sure that the technology is actually implemented pursuant to that plan. measure and monitor the technology as you go through audits and other kind of monitoring techniques to make sure you can make adjustments as needed, especially if there are issues that are identified as you move forward. So those are certainly kind of some basics of compliance for implementing any type of technology, but certainly very important when it comes to a new technology such as artificial intelligence. So next up on the agenda, mortgage and lending, and we have two colleagues who are going to help walk us through those issues, Michael Affable and David McGee.
Thank you, Andrew. Yes, my name is Michael Affable. I'm an associate in the financial services group, and I'll be joined by my colleague David McGee, who's also an associate in our group. So the CFPB has been very active in the mortgage space in 2023, and especially they are continuing their focus on fair lending and redlining, and have also come down on lenders for HMDA related issues. So we're going to talk about the fair lending and redlining issues in a bit. But just to give you a sort of overview, the CFPB also is looking at RUSPA Section 8 issues. And last year, it issued its first public enforcement action against a mortgage lender and a real estate broker for violating, for allegedly violating RUSPA Section 8. And for just a review, RUSPA Section 8 covers or makes illegal the payment of a thing of value for kickbacks or referral fees for the referral mortgage-related business. And in that enforcement action, the mortgage lender was accused of providing sort of subscription services and subsidized sort of social and marketing events to the real estate brokers who had provided that lender with mortgage-related business. And then we see earlier in the summer of last year, the CFPB was starting to signal that it might want to simplify its mortgage servicing rules and put out sort of a request for information, not an official request for information, but sort of on its blog and said, look, if there's anyone who would like to provide the CFPB some information about this, they are listening to that. We haven't seen any more activity on that in 2023, but it might come back up in 2024. So now, David, why don't you go ahead and tell us what are the federal housing agencies doing or had done in 2023?
Yeah, thanks, Michael. I know we've thrown kind of the alphabet soup of regulators at everyone today, so we'll just talk about these ones briefly. In 2020, the government-sponsored enterprises and the other federal housing agencies had to react swiftly to COVID-19 and the challenges borrowers were facing to make mortgage payments. One way they did that was by implementing home retention options, which came in the form of forbearance, deferrals, modifications, refinances at lower document requirements or lowered requirements that would ordinarily be required of a borrower going through a refinance or a mortgage modification. Throughout 2023, we've seen these agencies continue to consider these COVID-based options moving forward, largely in due part to economic conditions at a macro level and still pockets of the COVID-19 pandemic affecting borrowers. Just recently, at the end of 2023, VA even took the step to ask mortgage servicers to pause any foreclosure activities on VA loans and extend the availability of their COVID-19 refund modification program into 2024. Into 2024, we expect that other federal housing agencies might do the same. We can move on to the next slide and back to Michael.
Yeah. Yes. So also in 2023, and Max had already covered this, the federal banking agencies had proposed a rule to adopt the Basel III Endgame capital proposal. And while Max did a great job of kind of giving the overview for Basel III Endgame, we'd like to talk about how it's going to affect mortgages, in particular banks providing mortgages. What it would do is increase the capital risk weights for mortgages, both mortgages that are held on portfolio and those that are going to be sold to the GSEs. And in particular, it would affect loans with lower loan-to-value ratios. And so actually, the Bank Policy Institute and the Urban Institute have come out pretty hard against this proposal, saying that it would hurt lower to middle income consumers who frequently who need loans with lower to loan to value ratio mortgages. Right. So what I might do, could see in the future is if the Basel III Endgame is adopted as proposed, is we may see higher interest rates on loans provided by banks who are subject to these capital rules, or banks may get out of mortgage lending at least a little bit altogether, and then and that lending might shift to non-bank lenders. David, do you want to go through what the state financial regulators are doing?
See, Andrew, would you mind moving to the next slide? I'll roll this discussion into our. Oh, it'll be our final slide. So, Michael, why don't we focus on fair lending before we go to the states and other state level activities?
Sure. Yeah. So fair lending, as I mentioned earlier, is a top concern for the CFPB and the DOJ. The CFPB earlier in 2023 took two separate actions against two mortgage lenders for providing inaccurate HMDA data. And this is the data that is that mortgage lenders are supposed to provide to the CFPB about the demographics of applicants for mortgage loans. These two particular mortgage lenders were accused of not requesting that demographic data from their borrowers and then filling out inaccurate information on their HMDA data filings. The DOJ separately has been going after lenders for redlining issues. We saw 5 separate settlement agreements with 5 mortgage lenders under its Combating Redlining Initiative. And as we heard from Liz earlier, the CFPB and DOJ jointly filed a lawsuit against another mortgage lender for discrimination under the Combating Redlining Initiative. We also saw the CFPB and the DOJ issue a statement about the use of immigration status in lending. And the CFPB is very closely looking at the issue of appraisal bias. There have been hearings throughout 2023, and there'll be one coming up here very quickly in 2024 to address appraisal bias with both the Federal Housing Agency and the bank regulators looking at that issue. Andrew, could we? Yes, there we go.
Great. And as I alluded to, for some state issues, although I know we have one colleague speaking on this more broadly, so I won't step on his toes too much. States, especially in interest rate caps and EWA, earned wage access, have been very active in 2023, either releasing guidance to explain how they believe earned wage access products fit under existing lending regulations, or passing new laws and regulations to license such providers separately. Nevada, Missouri, California, Connecticut, Maryland, Arizona, and Montana are all good examples of states that have already considered this issue in some way, shape, or form. And as you can see from the slide, legislation is being considered in a variety of other states to also have EWA continue to be a priority for state regulators when it comes to licensure and treating those products as potentially as loans.
Great. Thank you, Michael and David, for that. And finally, for our last segment here, we've got our colleague, Brandon Wong, who comes from our Los Angeles office, who can talk about state developments. You know, we've spent most of our time during this presentation talking about the federal issues, but the states can be just as active when it comes to enforcement and rulemaking. And in fact, I think we probably see that in our day-to-day legal work. It's oftentimes the state issues that keep us just as busy as the federal issues. I'm sure the same is for our clients. So Brandon, with that, why don't you walk us through what we should be thinking about on the state front?
Yeah, thanks, Andrew. Yeah, like Andrew mentioned, my name is Brandon Wong. I'm part of our LA office, financial services group. We're truly a bi-coastal practice. And Andrew couldn't be more right. We could spend an entire day probably on state level enactments and developments in the financial services sphere, but we're going to get through a couple of the major highlights and look ahead into what we expect to see in 2024. And I think the top line is that we should expect that the state AGs and other regulators are going to be on the lookout for any areas that could impact consumers in traditionally vulnerable areas, such as federal student loan payments are a big one. As folks might recall, June 30th of last year, the Supreme Court decided to invalidate the Biden administration's student loan forgiveness scheme, and in doing so, that put federal student loans back on the path to repayment. And, in the intervening months after the Supreme Court decision, state regulators made a lot of noise about returning to repayment and protecting their borrowers. And this was no clearer than when 19 states and their AGs sent a letter to President Biden and his education secretary urging them to limit the harm that borrowers would face during the repayment period. And so one of the things they also said is our offices stand ready to hold companies that cause financial harm to our borrowers accountable for any unlawful conduct. So we should take them at their word. We expect that we would see, UDAP enforcement actions in the next year. One example of this, Empire College out in California was subject to a consent order by the Department of Financial Protection and Innovation. It offered installment loans to students, their own loans basically to finance their education. But they did so without possessing a student loan servicer license under the Student Loan Servicing Act of California. And so enforcement action was brought and they were ordered to obtain a license and stop collecting loans until they did so. In addition to servicing, we expect that there would be, rules and enforcement actions targeting private education finance and short-term vocational program as well. Earlier this year, DFPI regulations took effect that required licensure of student loan servicers. And this obligation now expands to more non-traditional sort of education financing products, as that term is used in the regulation. And this encompasses income share agreements, installment contracts, and it makes clear that those things are actually student loans. So if you're a provider of those things, you should definitely make sure that you are in compliance with that regulation. And in short-term vocational news, the CFPB and 11 other states sued a company called Pre-Hired last year, put it into bankruptcy, and in an adversarial bankruptcy proceeding, managed to get a consent order against this company that offered training courses to folks who wanted to be in software development. They offered income share agreements to those folks who couldn't afford to pay the $30,000 in tuition up front. And one of the things that the CFPB and the state AGs alleged was that Pre-Hired didn't disclose important loan terms to consumers, including when repayment would be required. And some of its affiliates also engaged in deceptive debt collection practices. And so as part of that settlement, it had to pay $4.2 million in refunds, had to cancel all outstanding income share agreements, which is a lot of money, $27 million, and shut down permanently. One more thing we might see, employer-driven debt. As folks might recall, in 2022, the CFPB made a lot of noise about employer-driven debt and asked for the public's feedback on their experiences with it. And in 2023, they released a report showing the results of that. Here at the state level, we're seeing similar moves. The California DOJ, for example, in July of last year, put out a bulletin saying that employer-driven debt is going to violate several portions of the state's code, including the Labor Code, the State Debt Collection Act, the big one, the California Consumer Financial Protection Act, and the Unfair Competition Law. So we're starting to see the states near the federal government. Another area we might see is the rent-to-own and lease-to-own products and property-related lending is increasingly coming under fire from states. A big one last year was INRI EasyKnock. This company, a prop tech company, entered into an assurance of discontinuance with the Massachusetts Attorney General. It offered something called a sale leaseback product, which is where a consumer sells his or her home to EasyKnock and then becomes a tenant of EasyKnock and pays rent. EasyKnock engaged in a variety of unfair and deceptive acts. It marketed its product basically to folks who were searching the internet for loans. Its telemarketers never disclosed or corrected, this fact consumers never corrected consumers when they said that they were seeking a loan and didn't clear that up. So the AG thought that was deceptive and brought an enforcement action. And so this is now settled for about 200 grand. And now the company is no longer allowed to bring these sale leaseback transactions to the state. Another big one for Massachusetts is the state AG brought a lawsuit against a company called MD Realty. And it offered a product called a homeowner benefit agreement. And essentially, it was a small dollar loan, cash payment to homeowners in exchange for a very long 40-year exclusive right for MD Realty to act as the listing brokerage if the homeowner decided to sell. And the AG was particularly incensed by that because MD Realty had the true terms of the contract, indicated that it was a loan and it wasn't complying with all sorts of disclosure laws in the state. And then, MD Realty was also using illegal methods to record mortgaging of those properties. And so, as part of its lawsuit, the AG got a preliminary injunction that required it to discharge all mortgages that it had in the state and to prohibit it from bringing new ones. Possibly as a result, MD Realty filed bankruptcy in September of last year. And several other state attorney general have also brought cases against this entity. So we heard earlier that the CFPB and the FTC, and actually the FCC is also trying to regulate junk fees, but so too are the state attorneys generals through enforcement actions and regulations. On the enforcement side, here in California, the DFPI brought an action against Cordova Financial. It's an internet installment lender. It partners with third-party service providers. And one of the things that it failed to disclose to consumers, but knew, was that payments made via this third-party servicer would cost a fee to pay by phone. It didn't disclose that. And so the DFPI brought an enforcement action. And as part of the settlement of that action, it was ordered to pay $50,000 and disclose the fees in the future. On the regulatory side, the governor signed SB 478 in October. That takes effect later this year in July, so there's still time to comply with it. And essentially, this new law, SB 478, amends the California Consumer Legal Remedies Act to make it unlawful to advertise, display, or offer a price for a good or service that doesn't include mandatory fees, all mandatory fees, except for postage, shipping, and handling, and taxes. And the state's very serious about this. There are a whole litany of penalties that you could face if you don't do it. There's actual damage, punitive damages, restitution, hefty civil penalties, $2,500 per, injunctive relief, and attorney's fees and court costs, which is definitely a lot of money. So you should make sure if you're charging for something that you display all of those required prices. Massachusetts has something similar to address what it thinks are deceptive junk fees. It would also require clear and conspicuous disclosure of the total price of a product with the same sort of caveats for government fees and whatnot. So 2 states now, California and Massachusetts, probably more coming along the way. And we probably think we might see something in Washington as well. In 2022, the state came out with a survey showing that a large portion of its population recalled being charged a fee that they didn't know about until getting to the payment page. And 36 reported that they were charged a fee they didn't know about until after they completed the transaction. So the state is aware of this, and we expect that there might be more regulatory enforcement developments. Okay, and finally, folks might be aware of state efforts to regulate, the true lender of bank fintech partnerships. In California, the DFPI brought a lawsuit against Opportunity Financial, which is a Chicago-based fintech. It worked with a Utah bank, FinWise Bank, to offer loans in excess of the state's usury cap that was implemented in 2020. The DFPI sought a preliminary injunction, but later last year, October 30th, right before Halloween, the court denied the preliminary injunction in a very long and very reasoned 62-page opinion. But among other reasons, the DFPI, according to the court, would not succeed on the merits because FinWise really had skin in the game in terms of using its own funds to lend, still owning the loan, even though OppFi purchased the receivables. So all of that. Of course, this is just a preliminary injunction. We'll see what happens in the future, but this is a setback for the FBI. And finally, California last year finalized some regulations related to commercial lending to small businesses. This is a trend that we're seeing throughout the states, requiring disclosure. And now California took it a step further to make it illegal to engage in deceptive practices related to commercial loans. Those regulations went into effect October of last year, and we haven't seen any enforcement actions yet, but it's only a matter of time before the FBI brings one.
Great. Thank you very much, Brandon, for that. And with that, we've come to the end of our presentation. We touched on a lot today, but I'm sure there's a lot more that we could have covered. I think at the end of the day, I've been participating in this annual overview for a number of years, and I think we normally hit the mark pretty well in terms of flagging issues for the upcoming year, but there's always new issues that come up. So the only concluding thought, I guess, would be that from a compliance perspective, make sure you've got good internal procedures in place so that you can not only address all the different types of things that we've talked about today, but as new issues come up, unexpected issues, that you've got the right resources, right team in place so you can monitor, track that, put any changes or fixes in place so you can be just as flexible and nimble as you need to be as the regulatory framework remains uncertain for the upcoming year. Finally, the most important thing probably of the day is the CLE code, which will be CFS 2024. So the CLE code is CFS 2024. And with that, on behalf of Venable and all the panelists today, I'd like to thank you very much for attending this. Thank you.